Today we have James Rickards. He is the New York Times bestselling author of Aftermath, The Road to Ruin, The Death of Money, Currency Wars, and The New Case for Gold, which has been translated into 16 languages. He is the editor of the newsletter Strategic Intelligence and is a member of the advisory board of the Center for Financial Economics at Johns Hopkins University. As an advisor on international economics and financial threats to the Department of Defense and the U.S. intelligence community, he served as a facilitator of the first ever financial war games conducted by the Pentagon, and he now lives in New Hampshire. Welcome.
Thank you, Jay. Great to be with you.
All right, so we got coronavirus going on. We've got bazookas of money getting shot out in every which direction. And we have an entire government and pretty much economic shutdown. What's your take on everything going on? A lot of the things we discussed since I talked to you last seem to be in full play. Wanted to hear your thoughts on everything.
Sure. Yeah, I think they're in full play. The irony of my books, a couple of them, but particularly my last book, Aftermath, which came out in November 2019, so last November. All of those books, they had some history, they had some analysis, they had some economics, but they were, to a great extent, warnings, telling people what was going to happen, what they could do to prepare, how they could preserve wealth in a crisis, et cetera. And they had a good readership, and they were all bestsellers. But now that the crisis is here, the books are selling very well, and I'm happy for that. I'm very pleased when people buy the books. But my point is, it's a little late to do some of the things I was recommending. It's funny, I was recommending gold at $1,100 an ounce, $1,200 an ounce, $1,300 an ounce, $1,400 an ounce, $1,500 an ounce, and everyone yawned and said, hey Jim, call me the day before the crisis hits. I'll sell my stocks and buy some gold. And my answer was always, well, I'm not going to know the day of. I'll tell you what's going to happen, how bad it'll be, but I won't know the day before. And if I do, I might be a little busy myself that day. But what are you waiting for? Why don't you get ready now, because it is coming. So now, of course, at 1,600, actually, gold is zeroing in on $1,700 an ounce as we're speaking. Everybody wants gold. Good luck getting it. The mints are back ordered, dealers are back ordered. Refineries are shut down. The Brinks distribution center, one of the largest gold vaults in the world at JFK Airport, is operating at half time because of, obviously coronavirus. They had another big Brinks distribution center and vault in Salt Lake City, which got hit by an earthquake. So good example of Murphy's Law. When things go wrong, if I ever catch up to Murphy, he's in trouble. But they had to shut that down to assess the earthquake damage, believe it or not. So the Swiss refineries, some of them are closed, some of them are open, operating at, my best information is maybe 30% of capacity, but then they can't ship to the United States because of travel bans. So my point, and there's a lot more to this than gold. I don't want to spend the whole time talking about gold, but my point is, you warn people, you try to help, but it's human nature. They don't listen. It has to hit them before it sinks in. Well, anyway, it's here. The books are still valuable because they give you a lot of insight as to what went wrong, why this will be a very long-lasting. I don't call it a recession; it's a depression. Let's call it what it is. But at a higher level, of course, we have the COVID-19, the coronavirus pandemic going on around the world. And one way to understand this, so epidemiology and the virus is a complex dynamic system. The superlinear exponential functions that describe how a virus spreads and why cases double every couple of days and why fatalities sadly double every couple of days. Like, why don't they just go up in a straight line? They don't. They kind of go up like a hockey stick. Well, epidemiology is kind of half biology, half math. I don't lay claim to being a virologist or doctor. I'm not, but I'm pretty good at the math, and I understand how the models work. And you can see that the economy is another complex dynamic system that don't really need to elaborate on that. Hundreds of millions of individual decision makers acting autonomously with various kinds of herd behavior and emotional overreaction, overshooting. That's a complex dynamic system. And finally, we have politics and geopolitics, which are complex dynamic systems. So what we have are complex dynamic systems crashing into each other. You start with the coronavirus, it crashes into the economy. That then crashes into the political and geopolitical sphere. And then down the road, I think we are looking at the next phase, which is social disorder, social unrest. One, example of this, a real world example, is the Fukushima in March 2011. I mean, what happened there? There was an undersea earthquake. All right, so that's seismology is a complex dynamic system. It created a tsunami. It didn't have to, but it did. The tsunami is hydrology. That's another complex dynamic system. That tsunami could have crashed into a barren island, but it didn't. It crashed into a nuclear power plant, caused 3 meltdowns and a hydrogen explosion, and that then sank the Tokyo Stock Exchange. So you had an earthquake that caused a tsunami, that caused a new radioactive meltdown, that caused a stock exchange crash. 4 independent systems. They're normally not highly correlated, but they all crashed into each other. So we're seeing something like that right now. So any one of the things I mentioned, the coronavirus, the economy, the political landscape, and beyond that, the veneer of civilization starting to wear thin, would be challenging enough to analyze on their own. But seeing how they're crashing into each other and affecting each other makes it even more daunting. But that's what we do. That's what I do with our models. And the key is to have the right models, the right analytic toolbox, if you will, or the right frame for thinking about it. I see all these analysts out on Wall Street talking about V-shaped recoveries and all that. I mean, that's nonsense. You cannot use 2008 as a baseline here. Even the dot-com, even 1998, long-term capital, 1994, the Mexican tequila crisis. None of those are proper baselines. You have to go back to 1929 and the Great Depression to kind of understand what's going on.
So 2 questions. First question is, do you have like a snow globe or a crystal ball I could stick a quarter in for you to read my future? Because so far it seems like you might also be fronting as a secret psychic.
Well, I don't have a snowball or a crystal ball, and I don't usually charge a quarter for consultations. But,
Okay, second part.
having said that, I do have predictive analytic models. I actually started a company with some partners to basically scale this up and apply it to other markets. And I do have a lot of experience. I work for the U.S. intelligence community. But what I tell people is, you don't need a crystal ball, and I'm not even the smartest guy in the room. You don't need the most IQ points. What you do need is the right model, because if you have the wrong model, you're going to get the wrong result every time. You're going to end up like the Fed or the IMF, where they haven't been able to predict the economy right for 10 straight years. They're off by orders of magnitude. I know a lot of those people. They're not dumb. They have IQ points, and they went to MIT and all that. They have computers and they have research staffs, but they have the wrong models, and so they're always going to get the wrong results. So what I bring to the problem is getting the right models, and it's not top secret. I mean, we use Bayesian theory, applied mathematics. We use behavioral psychology. Behavioral psychology is pretty well vetted. I mean, it's, you can read Daniel Kahneman if you want the master class. You can read Michael Lewis if you want the pop version. Larry Summers talks about it. People kind of get it, but it's not incorporated in Wall Street models. It's like, yeah, interesting stuff, confirmation bias, anchoring bias. I understand all that. I think the sociologists are now up to 189 separate cognitive biases that they look at.
Speaking specifically of psychology, right now there's obviously a big psychological effect,
Right.
and I feel like when I listen to Trump, I feel like he clearly doesn't want to shut things down, and he's really torn. And then this shutdown is a lasting impact on people. Obviously, there's a lot of differences between 08 08, 11 and now, in that there's such an incredible number of job losses that have already occurred, that have surpassed 2011. And I was wondering how do we what's your prediction on what's going to occur moving forward, both in the psychology of individuals, but how you see the markets and the economy and all these businesses? I just went into my favorite restaurant the other day for just to grab a to-go muffin real quick, and they said, "Thank you for coming in and supporting us." And
Right.
I said, "What do you mean?" They said, "No one's coming anymore, not even for takeout."
Right. We're doing the same thing here in the mountains. I mean, the restaurants are all closed and the grocery stores are open, but you don't want to spend more time there than you have to. I mean, I give a lot of credit to the people working there. They're kind of they're on the front lines along with the healthcare workers. But we have a local caterer, and we've been ordering meals from him. We don't have to. We've got plenty of food, but just to kind of help him keep his business going, we meet in a parking lot, and it's like a drug deal. We pay him in cash, and we take the stuff and we stick it in the
Sounds like
back of our stick it in the back of our van. But very nice guy, great food, by the way. But I mean, candidly, we don't have to spend the money, but we're trying to spend the money. We're
yeah.
trying to, like, hey, you got a couple of people working for you, and you got farmers and vendors, and let's just get this economy moving. But it's hard.
So
But
I know you only got a few minutes, so I was hoping you could tell me what your personal view and the people you're talking about. How do you see this playing out in economically and with all this stimulus? And there's talks that there's going to be even more, and it seems like they might even need to resort to giving most people money every month if they keep shutting things down. What are you foreseeing out of the economy?
right, well, a couple of things. I mean, you put your finger on the most important variable, which is psychology. Forget, if you have a 90-year time series, I might be interested, but these people looking at 20, 30-year time series and standard models, they have no idea what's going on because they don't have the right database. Number one, I grew up in the 1950s and the early 60s. I did not live through the Great Depression, but my parents did and my grandparents did, and I can tell you that had an intergenerational effect. All right, so I wasn't in the Great Depression, but in the 50s, we saved rubber bands. We collected newspapers. So you never threw away a tin can because we collected them. Like, we walked around the neighborhood with our wagons and collected tin cans and put them in like a Boy Scout, a collection point. We didn't think we were recycling or saving the environment. We were like, hey, tin's valuable. It's got steel in it. It's like, let's make tanks or whatever we need to do. We had that, Depression and I'll say World War II mentality. In World War II, people had victory gardens. They were growing food in their backyard because their industrial agricultural complex was trying to feed the troops. And you didn't waste money. You didn't throw away leftovers. You didn't spend extravagantly. Now, by the 70s, that had all worn off, and here comes the baby boom, and we're spending like crazy and have been ever since. But my point being, the effect of the Great Depression, which took place, of course, in the 1930s, lasted until the 1960s, even later. It was 30 years before that mentality really wore off. And in my view, what we're going through right now will have a similar impact, which is why we will not have a V-shaped recovery. Have to be, yes, straight down, absolutely. And also bear in mind, in the Great Depression, unemployment went to 25%, but it took 3 years. This happened in 3 weeks. I mean, there has never been anything like this in U.S. history, ever. The aggregate statistics will be comparable to the Great Depression or worse, but the time frame is greatly compressed. It's a shock. People have barely internalized this. I mean, you can look at the headlines and say, "Oh, stocks are up, stocks are down, whatever." But this, show me anyone who doesn't know someone who's been laid off, hours cut back, run a proprietor where no one's in the store, et cetera. So I know lots of people, and I'm sure you do as well. I mean, everyone's affected by this, if not worse. Pray for the people with the virus or people who are in critical care. So, and so let's just say 2 months from now, I'm making this up because I don't know if it'll be 2 months from now, but let's just say 2 months from now, President Trump comes out all clear. We got this thing under control. It's contained. We got the testing kits. We got plenty of medical. So let's get back to work. Who says people are going to run right out and go to the movies or go to a concert or join a parade or go to a restaurant? Of course, some will. It'll trickle back slowly. But this could affect people's behavior and consumption for years, if not longer. Number one. Number two, In terms of the V, again, I'm sure you remember in 2009, 2010, what were we hearing about on CNBC? It was, green shoots. Remember green shoots? That was supposed to be this sign. It's like Chauncey Gardner being there. It's the sign that the economy is coming back. There were no green shoots. We had 11 years of 2.2% growth. Average annual growth since of all recovery since 1980 was 3.2%. We grew, but we were running on a new track that was a full percentage point lower than the long-term average growth. If 1% doesn't sound like a lot, I suggest the following. Take 1% times the $22 trillion economy, compounded over 10 years, and see how much wealth was lost. The answer is over $4 trillion. That's how much money we left on the table. The concern now is that, the economy will be open for business, but we might be on a new growth path, even lower, maybe, I don't know, 1.7, 1.8%. Again, getting nowhere near the former trend. Meanwhile, we're piling on $5 to $10 trillion of debt and spending. And by the way, this is not stimulus. It is spending. It is monetary ease. They're printing the money and they're pushing it out the door. No question about it. This is not stimulus. This is like when I was a Boy Scout, I learned to apply a tourniquet. It's a little messy, but the point is, you put a tourniquet on to stop the bleeding, to save someone's life. It doesn't mean the patient's up and ready for a triathlon. It just means you save their life. So the money the government's putting out the door, will it keep some lights on? Yes. Will it preserve some jobs? Yes. But that's not stimulus, and it won't be stimulus because the debt is too high. That's a whole separate discussion. Same thing with the Fed. And by the way, in the $2.2 trillion in the CARES Act that the government approved a couple of weeks ago, and there's more on the way, by the way. We'll see more of this in May. But in that $2.2 trillion, there was $450 billion set aside to recapitalize the Federal Reserve. And I've said for years, look at what the Fed has done. They guaranteed commercial paper. They guaranteed corporate bonds. They guaranteed municipal bonds. They guaranteed money market funds. They guaranteed the primary dealers. They're pumping money out the door. Who guarantees the Fed? And that question kind of hangs out there. Well, we just kind of found out the Treasury is recapitalizing the Federal Reserve with $450 billion. But of course, the Fed is a bank, or at least it acts like one. They're going to leverage that 10 to 1. That means they can print $4.5 trillion, okay, using the $4.5 trillion using the $450 billion in new capital. Their balance sheet is already at $5 trillion today. That's higher than it was at the height of QE3 in 2014. So you're starting with a $5 trillion base. Throw $4.5 trillion on top of that, because that's how much they can lend with this new capital. You're approaching $10 trillion on the Fed balance sheet, which is almost 50% of GDP. These numbers are not only off the charts; they've never been seen or heard of or even conceived. But that's what we're doing.
Tell me why the dollar is doing so strong. Some people look at it and say, you're overreacting. Look at how well the dollar is doing. It's I think the dollar index is over 100 right now. What's going on there?
Why do you privilege the dollar as a numeraire? In other words, when people say a strong dollar, what do they mean by that? Well, they're
Every
looking
other
at
currency is weak, or what?
Well, yeah, that's the point. You're comparing currencies to currencies. Where's the ruler? Where's the yardstick? And where's an objective non-currency measure of the strength of currencies? There isn't one. Well, I can think of one. We'll get to it in a second, but there isn't one. So in other words, what you're really, when you say the dollar's strong, and I'm not picking on it because everyone in the world thinks the same thing.
I don't. I'm trying to.
No, it's a good question. So people are looking at the euro US dollar cross rate. They're looking at DXY, which is a basket. They're looking at the Bloomberg dollar index. There are a number of indices out there. Yes, you're absolutely right. The dollar is stronger by those measures. That's because there's a flight to safety. We at least have, a little bit of yield on a 10-year note, not much. It's I'm looking at a screen here, it's like, I don't know, 10 basis points or something, but it's better than negative, which is what you get in Europe and Japan, Switzerland, and elsewhere. But yeah, it's a flight to quality. The dollar is stronger than these other currencies, but none of them are objective metrics. The only objective metric is gold. So watch, if you want to know how strong the dollar is, don't look at the euro dollar cross rate. Look at the dollar price of gold. And think of gold by weight. And if the dollar price is going up for an ounce, that means the dollar is weaker. So when you say the dollar is stronger against the euro, yes. Against the yen, yes. Against gold, no. So is the dollar stronger or weaker? Well, that depends how you measure it. And I prefer gold because gold is money, but it's not a currency. And so it is an objective measure. Um, by the way, the US doesn't mind a strong dollar when we're trying to throw a lifeline to other countries. So Europe's in distress, China's obviously in distress, et cetera. So we're saying, okay, we'll bear the cost of a strong dollar to help you. You know, if you cheapen the euro, maybe you'll sell a few more Airbuses, maybe you'll import a little inflation, maybe you'll fight off the deflation, et cetera. It might help the European economies. But that only goes to a certain point. And the point is, when is the US economy so weak that we turn around and say, sorry, guys, now we need the cheap currency. We're the biggest economy in the world. If we go down, we take you with us. So we need the weak currency to import some inflation ourselves to help our exports, et cetera. My expectation is we'll get that later this year. So I would look for a strong dollar from now until maybe September. But September, October, when the full extent of this has begun to sink in, I would expect the Treasury would engineer a policy of a weaker dollar because the U.S. economy itself will be in such distress.
Right. I want to ask you two more questions. Only got a few more minutes before your next interview. So quickly, and I asked that previous question. Obviously, I'm very, I've got my holdings in physical gold, physical silver, and I also speculate a bit in some of the top mining stocks. So I'm already on board that train. But I wanted to ask you, what are, quickly in conclusion, and it's an often criticism that people that discuss these types of things say, well, you're doom and gloom. Give me some solutions. Let's talk, because I want to ask one more final question. Give me just very quickly, you can just bullet point off some things.
Sure. Yeah, I'm not a doom and gloomer. I like to think I'm a realistic analyst. If there's bad news out there, I won't run away from it. I'll tell people, but I'm not a pretty optimistic person. But I would increase my allocation to cash. First of all, we're going to get some deflation. Cash does very well in deflation. Your cash is actually worth more. I'd have gold. I recommend 10%. Don't back up the truck and get 50%, but 10% in gold will serve you well. Cash will, first of all, do well in deflation. Also gives you optionality that's often underestimated. But if you go into an asset class and it turns out to be the wrong one because, you thought we'd have deflation, we got inflation, or vice versa, it's often hard to get out of the asset class. You have to cross the bid offer, pay commissions, or maybe you lost money. But if you have cash, you can sit back, take a deep breath, look at the landscape, wait for the opportunities, and you can be the one to pivot in very quickly. I also recommend treasury notes. I know the yield is really low, but it could go lower. I've spoken to top Fed officials. They are actively considering negative interest rates. They haven't made a decision. I don't want to overstate that, but I was surprised at how relaxed they were at even discussing it. So that's on the table. And of course, that would make any note with a positive yield would generate capital gains in a world with negative interest rates. So I would recommend treasury notes, cash, physical gold or silver, seasoned to taste. We're not at the low of the equity markets. I know stocks are having these 1,000-point up days and 1,000-point down days. I get it, but this is nowhere near a bottom. So I'd be out of equities into cash, gold, and treasuries, and I would be patient. And there'll come a time to get back into stocks, but we're not there yet.
Cool. My other thing that I'm into that, I wish I could ask you about right now, but I want to ask you one other question is I've got some holdings in some of the top gold mining companies, which we'll see how that pans out with some of the mining shut down. But I wanted to kick you a scenario. Russia announced last week they're not going to buy any more gold. They're in this oil war right now. Have you considered, okay, what if Russia goes, they kick the scenario and they go, we're done with it, we're good. And there's all these talks about COMEX being short and on the amount available. Okay, what if Russia goes, we're going to clean out COMEX and we're going to take a delivery on it. It crashes COMEX. The price of physical gold goes through the roof. They double or triple their assets or liquidity for this oil war. The price of gold goes 2,000, 2,500, 3,000, and they fund the dethroning of the United States dollar, the petrodollar, and take control of the oil supply and the oil trade in the world. Is that a scenario at all? Is just something I thought in
Well, that's a lot to unpack. That's about 10 hours worth of answers, but
my
I'll
head?
try to do it in
You got
60
10
seconds.
hours?
Yeah, a couple things. Number one, the Russians are very cagey buyers. They've taken their they've got gold as 20% of their reserves. Round numbers, they have about $500 billion in reserves and about $100 billion in gold. So the 20%, that's a pretty high number, higher than any country I can think of except the United States. Very few people know that. When we say how much of the U.S. reserve positions in gold, the answer is over 70%.
Wow.
China's about 2%. So don't sell the U.S. short, of course. But yeah, they've got a big allocation to gold. I've had this debate with my friends in the national security community, and they're like, "Oh, Russia's really taking a beating because the price of oil is going down. They depend on oil and all that." I said, "Look at their balance sheet. Look at the central bank balance sheet. Look at what's in gold. This kind of panic, they're making more on gold than they're losing on oil." And they go, "Oh yeah, you're right." So that there's your theme, I think, is the correct one, even if I don't subscribe to every twist and turn. COMEX is doing a pretty good job of crashing themselves with no help from the Russians. So I'm not sure that the Russians are intervening in that market. But here's what's going to happen with COMEX, and it may happen in the next couple of weeks, by the way. Um, there will be long people who are long COMEX futures who will put in notice to stand for delivery. There's nowhere near enough gold in the warehouse, nor will there be. They can't even, they had to change the contract specs so they could count London 400-ounce bars on a new 400-ounce contract they started. But London doesn't want to ship the gold to New York, so that's not coming over anytime soon. But here's the point. What they will do, and I'm enough of a geek, I've actually read all the exchange rule books. Every exchange rule book has a rule that says we can change the rules. So I'm serious. So when you hear like the Hunt brothers were whining in 1980, "Oh, you guys changed the rules." Well, yeah, there's a rule that says we can do that. What they will do is if there's a rule that says we are not a source of supply, they only allow you to stand for delivery just to kind of keep the price in line. But if the notices of stand for delivery overwhelm the gold in the warehouse, which could happen, by the way, in the next couple of weeks. We may be heading right into that. They will announce that you can trade for liquidation only. Deliveries are suspended. Trade for liquidation only, which means if you're long, you can sell a you can close out your position by selling. You can roll it over, and you'll get your check for your profit or loss, probably a profit, but you can't take delivery, and so they can just do that now. It doesn't mean the exchange crashes. It does mean the price of gold goes to the moon, because that would be a huge signal. So they'll do what they need to do to save the exchange. This is why I've always told people, "Oh, I got gold, and we got a COMEX future, and I got a London bullion market, unallocated forward, and I said, that's not gold. Those are contracts. They have some price exposure to gold, if you want to think of it that way. But if they close the exchange, how good is your ETF? If COMEX is trade for liquidation only, how good's your notice to take delivery? Et cetera. And there's all these paper contracts. They can be suspended. They can be terminated. The issuer can claim force majeure, which just means something bigger than us happened. And I'm not saying they'll steal your money. They'll send you a check for your profit and loss. But you're like, wait a second, I don't want that. I want the gold. Or I'm not worried about today's price. I want tomorrow's price. It's going to the moon. Too bad. Here's your check. You're out. So that's what will happen. But people have spoken about it a long time, and the reasons why it hasn't happened. But April could be a train wreck. See what happens later this month.
That's fascinating. Fascinating. Well, thank you very much for your time, Jim. I know you're a busy man, and wishing you, your family, and everybody well. And we sincerely appreciate the work you're doing in the world.
Thank you, Jake. Keep well.